So hi everyone, today our group will be present a financial performance analysis of Petronas Chemical Group Berhad and Petron Malaysia Refining and Marketing Berhad, two companies operating in the oil and gas industry and listed on Bursa Malaysia. The analysis is based on the published financial statement for the most recent 2 years. We apply key financial ratios such as liquidity, profitability, efficiency, solvency, and market ratio to evaluate and compare the financial performance. Through this comparison, we aim to identify the similarity and difference between the two companies, explain the reason for any variation, and determine which company shows stronger overall financial performance.
Now I will explain of the background of company, which is Petronas Chemical Group Berhad or PCG. PCG is a leading Malaysian chemical producer and a listed subsidiary of Petronas, placing it strategically in the oil and gas value chain. Its core business is producing key petrochemical like olefins and polymers, which are essential for downstream industry. It operates large integrated facilities benefiting from economies of scale, and PCG major advantage is its strong integration with Petronas. This ensures a stable feedstock supply, reduce risk, and support cost efficiency, leading to more stable financial. From a financial perspective, PCG is capital intensive and its performance is tied to global commodity price that makes it a perfect case study to analyze how scale and integration affect financial performance in the sector and why ratio analysis is so important for this company. Now I will explain of the background of company, which is Petronas Chemical Group Berhad or PCG. PCG is a leading Malaysian chemical producer and a listed subsidiary of Petronas, placing it strategically in the oil and gas value chain. Its core business is producing key petrochemical like olefins and polymers, which are essential for downstream industry. It operates large integrated facilities benefiting from economies of scale, and PCG major advantage is its strong integration with Petronas. This ensures a stable feedstock supply, reduce risk, and support cost efficiency, leading to more stable financial. From a financial perspective, PCG is capital intensive and its performance is tied to global commodity price that makes it a perfect case study to analyze how scale and integration affect financial performance in the sector and why ratio analysis is so important for this company. Now let's look at our second company, which is Petron Malaysia Refining and Marketing Berhad. Petron Malaysia is a Bursa Malaysia listed company operating in the downstream segment of oil and gas. It's a subsidiary of the Philippines-based Petron Corporation and plays a key role in Malaysia energy supply through refining and marketing. Its core business is refining crude oil and marketing products like petrol and diesel that make it a pure downstream player, an operation that is capital intensive and relies heavily on efficiency. Finally, its performance is driven by volatile factor, global oil prices, refining margin, and operating costs. It operates in a tough regulated market where cost control and operational efficiency are everything. This makes Petron Malaysia an excellent firm for our ratio analysis. Its focused downstream model means that assessing its liquidity, profitability, and how efficiently it uses its asset is crucial. It also provides a clear operational contrast to PCG for our comparative study.
Okay, so for liquidity ratio, we focus on the current ratio and quick ratio to measure the company ability to meet short-term obligation. First, the current ratio decreased from 2.46 in 2022 to 1.90 in 2023. This shows that the company's short-term liquidity has slightly weakened. However, Petronas Chemical Group Berhad still has enough current asset to cover its current liability. Next, the quick ratio also declined from 1.93 in 2022 to 1.47 in 2023. This indicates a lower level of immediate liquidity when inventory are excluded. Even so, the ratio remains above 1, meaning the company is still able to settle its short-term liability without relying on inventory. Overall, although both liquidity ratio decreased in 2023, the company remained financially liquid in the short term. Okay, now let's look at the profitability ratio. First, the gross profit margin improved from 2.90% in 2022 to 3.28% in 2023. This shows better cost control and efficiency, which is a positive sign. Next, the operating profit margin increased from 1.73% to 2.03%, indicating that the company core operations are more profitable compared to last year. However, the net profit margin slightly decreased from 1.64% to 1.58%. Although margin narrowed a bit, overall profitability is still stable. Looking at the return on total asset, it decreased from 6.32% to 5.79%, showing that the company generates slightly less profit from its asset. This is moderate but not alarming. Finally, the return on equity decreased slightly from 12.42% to 12.27%, which is minimal. Shareholder return remains stable and satisfactory. Overall, the company shows improved operational efficiency with stable profitability and shareholder return.
Next, I will explain the efficiency ratio analysis, which show how effectively the company uses its assets and resources to generate a sale. Based on the graph, 5 efficiency ratio are compared between 2022 and 2023. First, the total asset turnover ratio decreased from 0.52 to 0.48. This indicates that the company generated slightly less sale from its total asset in 2023. Second, the inventory turnover ratio declined from 8.35 to 7.61, showing that inventory was sold at a slower rate compared to the previous year. This may indicate weaker inventory management or slower demand. However, account receivable turnover ratio improved from 9.32 to 10.32. This means the company was more efficiency in collecting payment from customers ratio. The improvement is supported by average collection period which decreased from 39 days to 35 days, showing faster cash collection. Lastly, fixed asset turnover ratio fell from 1.06 to 0.97, suggesting lower efficiency in using fixed asset to generate revenue. Overall, most efficiency ratio declined in 2023, indicating weaker operational efficiency. However, better receivable management had improvement cash flow. Now, I will move on to the solvency ratio analysis, which measures the company's ability to meet its long-term financial obligation. The debt ratio increased from 28.31% in 2022 to 30.11% in 2023. This shows that a slightly higher portion of the company asset was financed by the debt. The debt equity ratio also increased from 0.40 to 0.45, while the equity multiplier rose from 1.41 to 1.48. This increase indicated greater reliance on debt financing in 2023, which raises financial leverage. However, the most significant change can be seen in the return on interest ratio, which dropped sharply from 102.01 to 15.17. This suggested that the company's ability to cover interest expansion weakened considerably. On positive note, the long-term debt to total capitalization ratio decreased from 1.88 to 1.09 to 1.079, indicating a slightly reduction in long-term debt independence. In conclusion, the company faced high financial risk in 2023 due to the increased debt level and lower interest coverage. Although the long-term debt exposure, lastly, I will discuss the market ratio analysis will reflect investor perception and shareholder returns. The earnings per share or EPS declined significantly from 80 in 2022 to 21.8 in 2023. This indicates a sharp decrease in profitability available to shareholders. Despite this, the PE ratio increased from 10.9% to 34.1%, suggesting that investors are willing to pay more for the company share, possibly due to the expectation of future growth. The net asset value per share is increased slightly from 4.96 to 5.26, showing an improvement in the company underlying asset value. However, shareholder return weakened as opposed dividend per share and dividend yield declined. Dividend per share fell from 0.48 to 0.24, while dividend yield decreased from 5.54 and 5.58 to 3.35. Lastly, the market to book ratio decreased from 1.73 to 1.36, indicating lower market valuation relative to book value. Overall, while asset value improved, the market expectations remain high. Shareholders experienced lower earnings and dividend return in 2023.
Let's start with liquidity ratio, which measures the company's ability to meet its short-term obligation. Looking at the current ratio, we see an increase from 1.10 in 2022 to 1.28 in 2023. This indicates Petron Malaysia had more current assets compared to its current liabilities, which is a positive sign for its short-term financial health. However, the quick ratio, which excludes inventory, also increased from 0.64 to 0.76, but it's still below 1. This indicates that without selling inventory, the company's liquid assets are insufficient to fully cover its short-term debt. So, while liquidity is improving, there are still room for a better cash management. Next, let's look at profitability. The gross profit margin rose from 2.90% to 3.28%, and the operating profit margin increased from 1.73% to 2.03%. This shows that Petron Malaysia is managing its production and operating costs more effectively. However, the net profit margin declined slightly from 1.64% to 1.58%, and the return on asset, or ROA, dropped from 6.32% to 5.79%. This suggests that while core operations are improving, overall profitability and asset efficiency have softened slightly. On positive note, return on equity, or ROE, remained essentially stable around 12.3%, decreasing just slightly from 12.42% to 12.27%, meaning shareholders are still seeing consistent return. Now, let's look at efficiency ratio, which shows us how effectively the company is using its resources. The total asset turnover decreased from 3.85 to 3.66 times, meaning the company generates slightly less revenue from its asset base. Inventory turnover also slowed down from 60.83 to 60.41 times, and the account receivable turnover dropped from 40.44 to 12.91 times. This results in a longer average collection period from 25 to 28 days, which means it's taking longer to collect payment from customer. One bright spot is the fixed asset turnover, which improved from 8.54 to 8.67 times, showing better use of property, plant, and equipment in generating sales.
Next, we are talking about solvency ratio analysis. Based on the financial ratio analysis for 2022 and also 2023, several key changes can be observed. First, the debt ratio decreases from 53.47% in 2022 to 48.46% in 2023, indicating that the company relies less on debt and has a stronger asset position. Second, the return on interest ratio improved from 7.14 times to 9.21 times, showing that the company's ability to cover interest expenses has strengthened. Next, the debt equity ratio declined slightly from 1.05 times to 1.03 times, suggesting a more balanced capital structure between debt and equity. However, the equity multiplier increased from 1.97 to 2.12 times, which indicates higher financial leverage in 2023. Finally, the long-term debt to total capitalization ratio rose from 7.43% to 11%, reflecting an increase in long-term debt financing. So, in conclusion, despite higher long-term debt, the overall finance position is showing that it is improved, the debt is improved, and it is improved debt management and also have a stronger interest coverage in 2023. Now, we move into market ratio. Based on the market ratio analysis for 2002 and 2023, several trends can be identified. First, for EPS, it is decreased from Rm 2 ringgit and 10 cents in 2022 to 1 ringgit and 90 cents in 2023, indicating a slight decline in profitability available to shareholders. Next, the price earning or PE ratio increased from 2.06 times to 2.38 times, suggesting that investors were willing to pay a higher price per ringgit of earning in 2023. The net asset value per share rose from Rm 50 ringgit 50 cents to Rm 16 ringgit 93 cents, reflecting on improvement in the company net worth and also asset base. However, dividend per share and dividend yield were not recorded for both years, indicating that no dividend were distributed during the period. Now, finally, the market to book ratio or MB remained relatively stable, increasing slightly from 0.28 to 0.27, which showed that the company share were traded below their book value in both years. In conclusion, although earning per share declined, the company still showed stronger asset value and also maintained the stable market.
I want to present about comparative analysis. First is liquidity. Comparatively, Petronas is stronger in liquidity, consistently maintaining higher current and quick ratio. Although Petron improved its liquidity in 2023, it still lags behind Petronas. Profitability, in terms of profitability, Petronas experienced a sharp decline in 2023, while Petron showed slight improvement, though its overall profitability remained low. This indicate that neither company performed strongly in profit generation during the period. For efficiency, Petron clearly outperformed Petronas. Petron consistently record higher assets and inventory turnover ratio, indicating superior assets utilizations. Petronas, on the other hand, experienced declining efficiency in 2023. For solvency, regarding solvency, Petronas is financial more conservative with a lower debt level and reduced financial risk. Petronas relies more heavily on borrowed funds, making it financial risky despite some improvement in its debt ratio. For market performance standpoint, Petronas suffered declining earning per share and dividends in 2023, reducing shareholder value. Petronas record highest earning per share but continued to face weak market valuations as reflected by its market to book ratio below 1. Okay, first I will start with Petronas. Petronas show strong liquidity as its current and quick ratio remain above 1. This means the company is able to meet its short-term obligations comfortably. Petronas also has a low level of debt, which reduces its long-term financial risk. Even though its interest coverage ratio declined in 2023, the company is still able to pay its interest expenses. From a market perspective, Petronas is valued above its book value, showing financial stability. However, Petronas faces several weaknesses. The most noticeable issue is the significant decline in profitability in 2023. Profits margin, returns on assets, and return on equity all dropped sharply. Operational efficiency also decreased as shown by lower assets turnover ratio. In addition, earnings per share fell and dividends payments were reduced, which returns. Next, we move on to Petronas. Petron's main strengths lie in its operational efficiency. The company used its assets effectively, as shown by high assets and inventory turnover ratio. Petron also improved its liquidity position in 2023, indicating better short-term financial management. Although profit margins are low, Petron managed to slightly improve its operating performance, while returns on equity remain stable. On the other hand, Petron has some weakness. The company operates with very thin profit margins, making it vulnerable to cost increase. Petron also relies heavily on debt financing, which increased financial risk. Moreover, no dividends were paid in both years, and the market to book ratio remained below 1, reflecting low investor confidence.
The conclusion is Petronas, even though they are having a strong liquidity and low financial risk, but experience a decline in profitability and efficiency in 2023. It should improve cost management, optimize asset utilization, and also restore consistent dividend. For Petron, although operation efficiency and also asset utilization are high, low profit margin and also high financial risk remain concerned. The company should enhance profitability, manage debt carefully, and also increase the shareholder value. Overall, both companies should focus on sustainable profit growth, efficient resource use, and also prudent financial management to strengthen financial stability and boost market confidence.